Let's go to moving average and understand what the moving average is. Okay, should I explain? So we will cover till head and shoulders or price patterns today. Some of the students want me to make you understand head and shoulder. Just like our body, just consider that. We have two shoulders almost at the same price and our head at a higher price. The pattern looks the same. That the head is at a higher price and the shoulders are almost at the same price. So what does the head and shoulder pattern means? It's a pattern which shows that there could be a strong reversal in trend in that particular. Okay, so we are not skipping. Okay, we are not skipping. We are covering it. Don't worry. Okay, so we are covering. How does the head and shoulder look like? Let's understand. So head and shoulder, this is how the formation looks like. The head is on a higher side. So I'll give you an example of some prices here. Say an example of 625 is the head price. Left shoulder high is say at around 610. Right shoulder price is at around 612. Okay, so this means that the left shoulder and the right shoulder, the price are almost the same, and the head is higher to the both left and the right shoulder. What psychology it shows, if the stock moved to a price, it was in a, now any pattern to remain or give a reversal, it has to be in a prior trend, prior uptrend or a prior downtrend. So in case of head and shoulder, it has to be a prior uptrend. A stock has been in a prior uptrend, and after that the stock has started moving up, making a new high at 600 and say 15 or 610, say in this case example left shoulder. So 610 it went, then it went back and made say around 595. There was a correction, and after that correction the stock again went on to make a higher high. That is the tendency of the stock. Because it is in an uptrend, it is making higher high and higher lows. So here it is making up or taking a price of say 625, which is higher than 610. No problem still now. The problem starts when there is a correction say around 600 here, and the stock again moves and here it is not able to break the previous high of 625. Say it makes a 612. No problem still here. Now if you join the support line, how do you make a support line? You just join the low points and you extend it. You get a support line here. Okay, this is called the neckline of head and shoulder. The neckline is called an important support line for that particular stock. The problem starts when after making a lower high than 625, we start falling and we start breaking the zone of 595, 600, and we start moving down. This is a very dangerous pattern. It shows that for the time being, we might just stop out. We might just stop out from here. The stock has been in a very, very good uptrend, primary uptrend. No problems with that. But in the secondary term, maybe 3 weeks or maybe 3 to 4 weeks or a month, we might have a correction. It may be that this particular season, the results were not up to mark, or there could be that the sector is not in flavor, or there could be XYZ related to promoter or the company itself. The reason could be any, but the stock has started falling. And the stock has started falling.
Uptrend showing.
Yeah. Yes. Ask me.
The trend is showing uptrend.
Yes. Yes. Suppose there. Now let me take an example with you. Yes. If I suppose there is an engulfing pattern here, you had taken a trade, it gave a fall. Now you have booked your profit, and after that engulfing pattern, you have a head and shoulder pattern here. So it's a double particular reversal pattern you have got. Already you got a candlestick reversal pattern here, which was a bearish engulfing pattern, and now head and shoulder pattern has also given a break. That gives you double confirmation that probably this head and shoulder, and suppose generally the volumes are good when this trend line or the support line is broken. So if you get that volume is also supporting, you had a bearish engulfing pattern here, and now you're breaking this level. It's a very powerful tool that probably this head and shoulder will give you a sharp fall on the lower side. Harsh, are you understanding how you can apply it along with candlesticks? Yeah, I'll tell you the stop loss. We have not completed head and shoulders yet. So once the fall starts and the stock starts falling below the neckline, that is a very, very dangerous sign. It's a sign that we might just stop out and go for maybe a secondary term downtrend. Again, after the secondary term downtrend, we'll get a zone where we can buy the stock again. For the time being, it shows if you are long on the stock, it's time to exit or book profits. It might give you a good amount of correction. If not full, say about 70% of the stocks, it should be sold out. Now what happens? Once the close is below the neckline, the first day the close is important. So the close is below the neckline. I'm telling you, Harsh. So once the close is below the neckline one day, say this is the X day here. The close is below the neckline. You next day, day 2, if the low of that day, when the closing was below the neckline, is broken, if that low is broken, short, not keeping the high of this day where the neckline was broken, but 2 days before. So not this day, but maybe one day before that, whatever was the high. So it's not say yesterday, the neckline was broken on a closing basis. Closing is important, okay? The closing was broken. You don't take a trade today. Tomorrow you wait for the low to be broken of this day, today. If it's broken, then the closing, then the high of not today, but the high of yesterday, whatever was, you take as stop loss. Okay? Are you getting it? Now you expect at least X is the zone between head and the neckline. That much is your expected target. For this, I'll better give you an example. Say, in this case, the close below 595. Okay, so the closing is say around 593 of this day. The high of this day was say 600. So below 593 tomorrow, you will short. Okay, clear till here? And below 593 because it's the low below the neckline which is closed, the low of this day. So below 593 you short, keeping say this day when the closing was below the neckline, the high of that day was 600, leave it. The day before that the high was say 605. So you keep 605.2 as stop loss and you short below 593. Is it clear now? For that, I'll need to show you some example. Let's check if we have some figures here. Yeah, it's here. Let's understand. There are no figures, but a chart where we can understand this. Okay, it's a neckline has been broken here. This is the first day when there is a closing below the neckline. Is it clear? Now, below this low of this day, you sell or you take a short position. Clear? Harsh, clear? And you keep the high of this day, not this day, but this day as stop loss. Now it's clear? The high of this day should be kept as stop loss. Now for today, we have to wind up here because there's another session which is going to go on. So thank you so much for cooperating with me. Sound down. More we can discuss later. Okay. Thank you so much. For today, the session has to be closed. So we can continue next.
Okay. So ma'am, rest of the session, when will it continue?
That will be told by you by a coordinator.
Okay. Okay.
Okay. Okay. I think whatever I have taught you is clear to everyone.
Yes. Yes. Thank you.
Okay. Okay.